I just want to point out, a couple of weeks ago, Daniel Pinto from JP Morgan told our Francine Lacroix that the possibility of a 40% correction over the next 2 to 3 years is likely. And overnight, we've heard from cross-asset strategists out of JPM and their senior economists that chances of a recession in the next 3 years are 72%. Now, I know it's 3 years, it's a long time, but they're saying we're pretty close to the top. If it's that risky, Gerard, why would you bother staying in? Why not get out now before you have to start worrying about it?
The risks are rising. Our view for next year is that the odds of a US recession are rising, so therefore we're positioning in more of a de-risking phase from here. However, in terms of keeping overall risk, overall goals for so many investors is to stay invested, to seek some positive expected return. You've got to beat inflation. So being invested in a multi-asset portfolio across a range of assets, the likes of real assets, infrastructure, real estate, investment trusts, they can provide different sources of earnings. There are wider opportunities as well, such as European equities. The European economy is doing so well. Looking at emerging market equities, that's continuing to do well. So we think that ultimately stay invested, look towards the opportunities in a multi-asset portfolio, but to start to de-risk from US equities in particular and overall risk profile, start to reduce that and increase risk elsewhere.
What do you expect? The S&P 3000 target over at JPM is 3,000. I'm not saying that they're the benchmark, but they're a big bank, obviously, and a lot of people hear what they say. What's your S&P target? How much more do you expect to be able to get out of this bull market?
In terms of where we are in terms of the S&P right now, we see in the short term those potential for some increase followed by that strong momentum, the earnings. So we think the very short term that we could edge into single-digit gains from here. But by the end of the year, we would have concerns about where US equities are and the potential for that to then start coming off.
And one of the concerns that you have comes from where we are on the Treasury story, doesn't it? And the flatness of the yield curve. 9400 on the Bloomberg. If you want to pull up this chart, this is talking about beware of flat yield curves and how that can act as a precursor for US recession. I know this is something that you've looked at, Gerard. Others have talked about how things may be different this time. You don't go along with that idea?
No. This is our chart of the day. This is the one that we've been watching in fixed income and across our multi-asset portfolios for a long time. Our strategists point this out to be one of the key indicators. Have a look at this chart. It's so powerful. If you look at the prior US recessions, just before then, if you look at where the spread is between the US 10-year and the 2-year, you can start to see that that gets towards zero. So when the curve gets quite flat, just after that, the chance of recession increases. That's why we've really been concerned about the chance of a US recession rising and where we feel it's important to start to de-risking from the likes of US equities and look for other opportunities.
And that still applies even when we've got interest rates so low?
It still applies when interest rates low. It can be from a low interest rate or a high interest rate environment, and we're seeing it. We're starting to see that curve starting to flatten. We're starting to see the recession indicators pick up. We're seeing in early February the volatility pick up, and these are warning signs. But again, stay invested. There are opportunities in the earlier part of this year, we believe, but to position portfolios to ratchet down risk is wise for the longer term.